Welcome to Hindustan Foods Limited Q2 and H1FY25 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on beliefs, opinions, and expectations of the company as on the date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sameer Kothari, Managing Director, Hindustan Foods Limited. Thank you, and over to you, sir.
Thank you, Manav. Good evening and welcome to our earnings conference call. I am joined on the call by Ganesh Agekar, Executive Director, Mr. Mayank Samdani, Group CFO, and SGA, our Investor Relations Advisor. I hope everyone has had a chance to go through our updated earnings presentation that was uploaded on the exchange and our company website as well. This quarter's results are an apt example of the fable of the blind man and the elephant. Each part of this quarter says a different story, and my team and I will try and help address this as much as possible in the next hour or so. On one hand, the FMCG sector continues to contend with challenges stemming from the subdued consumer demand. However, since most of HFL's revenues comes from dedicated business model that guarantees our bottom line, the company's financial performance has been stable. While this was the off-season for beverages and ice cream, the company's revenue figures have in fact increased smartly. This is on the back of the shoe business and the ramping up of the Batti factory, which were not a part of the last quarter's numbers. While the revenues have increased, the overall profitability of the company was flat. The profit numbers were affected by the additional costs arising due to the integration of the shoe business. Which brings me to the last part of the puzzle. If the overall industry is slowing, will the company continue to grow, or is the current flattish performance going to be the norm for the next few quarters? To answer this, I have to hark back to our previous discussions where we had mentioned that we are in the process of identifying new customers and diversifying into new sectors to ensure long-term growth. We had identified ice creams, beverages, and footwear as high growth avenues that align well with our core strengths and operational capabilities. Our focus on these categories is already yielding positive results as we have seen measurable advancements in each area. In ice cream, we are tapping into the vibrant market with strong consumer demand, which is offering ample opportunities for expansion. We have achieved a significant milestone in this quarter by securing 2 new clients over the past 6 months. This development not only strengthens our market presence, but also positions us to become one of the largest contract manufacturers of ice creams in the country. By aligning with the major players in the industry, we are expanding our reach and reinforcing our reputation for quality and reliability, which is essential in building long-term partnerships and supporting sustainable growth of this category. In the beverages sector, we have made strategic acquisitions and expansions that are setting a solid foundation for the future growth. Our acquisition of the Mysuru factory around 5 years ago marked an important strategic entry that enabled us to extend our operational footprint to Assam, setting up a liquid line there, and then tapping into a key region for beverage production and distribution. Building on this momentum, we have recently finalized a beverage unit in Orissa, further broadening our geographical reach and production capacity. With this foundation, we are confident in our continued growth and market penetration across the country. Finally, our entry into the footwear segment provides us with a unique diversification strategy, leveraging our experience in manufacturing and our commitment to quality to meet the demands of a dynamic consumer base. While the integration of the shoe factories has definitely hit the financial performance of the company, we continue to remain extremely bullish about this sector and have expanded capacities in the south, which should enable us to grow this business rapidly in the coming quarters. So in summary, I can say that we are going to use the foundation of the stability provided by our long-term contracts to tap newer opportunities and newer clients. These newer opportunities and newer clients come with the promise of higher returns, but also with the cost of a higher risk. Together, these initiatives are part of a broader vision to build a robust, diversified business model that is resilient in the face of market fluctuations and capable of sustaining growth across multiple sectors. I will now hand over the call to Ganesh Argekar, our Executive Director, to brief you on the operational highlights.
Thank you, Samir. And good evening, everyone. I would now walk you through the operational and business highlights for Q2 and half year FY25. The company has signed up for an additional customer for the ice cream project at Nashik, making the site an anchor tenant model. This should enable the company to better leverage the factory. The total capex for this site is now estimated to be 185 crores, and the commercialization is expected in April 2025. The estimated capacity in the first phase will be 12,500 liters of ice cream, which would have various formats of party packs, sticks, tubs, and cones. The expansion of capacity at the ice cream plant in Lucknow with a capex of around 20 crores is in progress and will be completed before February 25. With this capacity expansion, we will be ready with 3 lines of cones for the coming season, in addition to the various formats of tubs, cups, and sticks. The board has sanctioned a greenfield plant in North India to manufacture ice cream. This will mark the third factory for ice cream for the company and the beginning of a relationship with a new customer. This will envisage an investment of 225 crores in phases. The network for the project is being lined up by our project team, and we are targeting to start commercial production for the ice cream season starting 2026. With increased demand seen in the beverage category, the board has sanctioned a further capex of 15 crores to expand our capacity at our Mysuru plant. This will increase our capacity by over 30% for manufacturing and filling of beverages. The land acquisition for the color cosmetics facility at Silvassa has been completed with a capex of 40 crores. The board has sanctioned an investment of up to 35 crores to acquire a company based in Odisha for bottling mineral water for a multinational company. With this now, I will hand over the call to Mayank Samdani, our Group CFO, to take you through the financial results for the quarter and half year ended 30th September 2024. Thank you.
Thank you, Ganesh. I will now run you through the financial performance for Q2 and H1 financial year 25. First, we will talk about the consolidated financial highlights of H1 FY25. The total income recorded at 1757 crores, which is an increase of 35.4% from the same period last year. EBITDA stood at around 148 crores, which is an increase of 36.6% from last year. PBT is at 68 crores, an increase of 12% over last year. Now, if we go to the Q2 performance of FY25, the total income is around 886 crores, an increase of 31% over last year. EBITDA is at 72 crores, 72.6 crores, which is an increase of 30.7% increase from last year. PBT is at 31.8 crores, an increase of approximately 2% over last year. The company's revenues were bolstered from the expansion of our shoe business and the operational scaling of OTC and wellness factory in Batti. These ventures have been pivotal in strengthening our revenue base and enhancing our overall market presence in these high potential sectors. Our dedicated manufacturing facilities, which are integral to our operational strategy, continue to deliver strong contributions to profitability in line with our expectations. However, the integration of the shoe business, while essential for our diversification efforts, introduced additional costs during this period. This incremental cost affected our overall EBITDA and profitability as we focus on aligning new operations with existing processes and achieving synergy with our manufacturing framework. In terms of cash flows, even though a portion of this cash flow was allocated towards supporting the working capital needs for our fully integrated shoe business and the ongoing scale-up at our factory, yet we achieved a healthy net operating cash flow for the first half of FY25 of 74 crores, a substantial increase from the from 24 crores recorded in the same period last year. This growth demonstrates our commitment to maintaining financial resilience even as we invest in the growth areas. Looking ahead, as our shoe business pivots towards profitability, we expect to see an upward trend in the profitability. Company net worth as on 30th September stood at 705 crores. Our gross block as on 30th September was at 1238 crores. Debt to equity ratio stood at 1.03 and cash and cash equivalent stood at 64 crores. With the board endorsement and the constructive discussion with our clients, we now have a well-defined path of capital investment, which is expected to raise our gross block to over rupees 1800 crores by FY26. With this, I would like to open floor for questions. Thank you.
Thank you very much. We will now begin the question and answer session. Participant present on the audio bridge who wish to ask a question may press star and one on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and two. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. We have our first question from the line of Faisal Hawa from SG Hawa. Please go ahead.
So, Samir, how is the ramp-up of our footwear division coming along? Would it be a fair statement to make that we are now at around 45-50% of total capacity? And if I may ask, how many footwear majors have we got an entry into? And are we like now approved supplier for almost all the footwear majors, or there are some left? And secondly, about the Dr. Scholl's facility, are we making any progress for all the approvals that have been made, and what is the capacity utilization at that factory?
So, Faisal, as far as the footwear business is concerned, you are aware that we acquired a going concern. The going concern already had some of the major leading multinational brands as customers. We actually have inherited an excellent plant roster from the previous customers, and we continue building on that. From that perspective, and because of various tailwinds that we've mentioned earlier, including BIS, import duties, etc., demand generation is not a problem as far as the shoe industry is concerned. It's more a question of integration. It's more a question of driving efficiencies. It's more a question of ramping up the capacities. Second, as far as the facilities, the healthcare facilities are concerned, you talked about the South IGK facility.
No, I think the Bati facility is by Dr. Scholl's.
You're absolutely right. So in the South IGK facility, there were no approvals pending. The approval which was pending was only for the Bati facility. And the Bati facility, like we mentioned in our previous call, last quarter itself, all the approvals except for the Russian FDA have come through. We've actually started producing all the products in that facility. I did mention it in our previous interaction as well that Bati did record turnover in a couple of months in the previous quarter. We do believe that the Russian FDA will come in Q1 of calendar year FY25, Q4 of financial year FY25, post which we should be able to resume exports to Russia as well.
So, do you see any kind of parallels between how the electronics manufacturing and assembly industry has evolved, and the same thing how it is now taking place with the shoe industry? Do you feel that something similar could happen, and we could be having some kind of a first mover advantage? And also, because as an organization, always we have been good at execution, we have some kind of a head start here.
You're absolutely right. I think we are banking on the contract manufacturing of the shoe being evolved in the same way that the EMS space is evolving. I think to begin with, the T1 vendors, which is the immediate vendors of all the brands, are setting up capacities or expanding in India. As capacities get built up, as scale comes in, you will see the ecosystem developing with T2 vendors coming in as well. Yes, you're absolutely right in drawing the parallel between the EMS space and the shoe industry. Of course, the per unit value of a shoe is much, much lower as compared to the electronics industry, and as a result, the revenue numbers may not be as high. But from an employment perspective, I think the shoe industry can be as big or as large as the EMS space.
I appreciate you answering my question so well. Thank you.
Thank you, Faisal.
Thank you. A reminder to all participants, you may press star and one to ask questions. I repeat, you may press star and one to ask questions. The next question is from the line of Nitish Rege from Chris Capital. Please go ahead.
Hi, thank you for the opportunity. Hope I'm audible.
Sir,
Yeah, Nitish, we can hear you.
Louder.
Yeah. So my first question is on the shoe business. So integration of the shoe business has resulted in additional costs, which has impacted our overall EBITDA and profitability in this quarter. So could you provide any quantum of these costs in Q2 and in 1H?
Yeah, I'm going to ask Mayank to answer that, Nitish.
So on a very broad basis, Nitish, this cost, integration cost is what we could have better is around 6 to 7 crores for H1, total H1, right?
And then Q2?
This is for entire H1.
Okay.
And averagely same in both the quarters because we are integrating from last 6 months.
Okay. And by when will the shoe business start contributing to our profit?
The expectation is as soon as possible. However, there are a couple of operational things which are going on. In the North factories, Ganesh and team are trying to get the efficiencies in terms of material, stocks, availability. If you take a look at our working capital numbers for this quarter, you'll see a huge increase in inventories, etc. So Ganesh and team have actually gone ahead and bought material, tried to ensure that the lines are not starving for raw material as well as other materials. And in the south, we've just started ramping up the capacities. Being a very hands-on industry, there's a huge learning curve. We've had to recruit as many as 500 odd people who are currently being trained as well as who are currently started manufacturing the shoes. I think it will be Q4 of this financial year when South will be fully ramped up to its capacities. And broadly, I would say around that time, we should be able to see positive numbers coming in from the shoe business as well.
Okay. And, could you also shed some light on the profitability we should expect from the shoe business?
Our expectation is it's going to be very similar to the contract manufacturing business. It's our first year, so I'm hesitant to give you any definitive numbers. But given that the overall business model is very similar to what we are doing, I do believe that the numbers should be similar to our existing businesses.
Okay. Thank you so much. I'll call back in the queue if I have any more questions.
Sure.
Thank you. A reminder to all participants, you may press star and one to ask questions. I repeat, you may press star and one to ask questions. We have our next question from the line of Priyank Chheda from Vallum Capital. Please go ahead.
Yeah, hi, Samir. What would be the total investment now in ice cream after the sanctions that we have got from the board, which is for 225 crores in the North India and a new facility in Nashik, which is around 185 crores. So total investment in ice cream would go to around 400-500 crores. Earlier we have invested around 250, if I'm wrong.
And the overall will go beyond 400-500 because we have already invested 250 crores in Lucknow.
Yes.
We are talking of investing around 400 crores more in these two factories. So it will be upwards of 600 crores when the entire, these three factories ramped up and all the investment is done.
So 250 invested in Lucknow, where we are investing another 200 crores and then another 200 crores in Nashik, right? So total 600 crores of investment.
250 crores we have invested in Lucknow, right?
Yes.
185 crores we are investing in Nashik. and another 225 crores in another factory in North, which is not Lucknow.
That's a greenfield.
That is a greenfield project, new customers, new sites, and this is a greenfield project.
Got it. And the asset turnovers are, I guess, are higher in ice creams around 3 times when we have to look it on a whole year basis. Is that correct understanding?
No, the ice cream is unfortunately, ice cream asset turns are little lower than the average of us because the investment size is more. So it will go around. It will be between 2 to 2.5 times asset turns in the ice cream.
Perfect. And on the Hyderabad plant of soaps and bar where we were ramping up, I'm not sure what would be the utilizations. Have we ramped up it completely, or is there anything that is left?
So Priyank, the Hyderabad facility was a dedicated manufacturing site, and in case of dedicated manufacturing sites, unlike let's say the shared manufacturing of shoes, the ramp up is quite quick in terms of our bottom line, right? So after we've ramped up the capacity, any kind of operating leverage from that site does not flow into us; it flows into the customer. So the soaps line, the soap bar line in Hyderabad is actually now nearly more than a year and a half old. We ramped it up within 3 months of the construction, and since then it has been performing quite stable. We are manufacturing around 45,000 tons of soap bars there.
Perfect. And just a final question again on the whole of the gross block of 1,250 crores. I understand that Bhaji facility is one of the shared manufacturing facility of around the investment of 150 crores, which is yet to ramp up. Any other facility where you think which is a shared manufacturing facility where ramp up can flow into the EBITDA leverage also?
Priyank, the Baddi facility is an anchor tenant model, which means that part of the capacity is guaranteed by our existing customer, and just the balance capacity is what is available for other customers.
Correct.
So I would be hesitant to say that it's a completely shared manufacturing facility because frankly a major part of our capacity is anchored by our existing customer there. Coming to in terms of the joker in the pack, it's actually the shoe business. The shoe business is a completely shared manufacturing facility. It has a huge amount of operating leverage, both in terms of operating efficiencies as well as in case of South in terms of ramping up from an production perspective. So I would say that's the bigger one, and we've invested I think close to about 100 odd crores in that business. So I would say that's the bigger joker in the pack.
Right, and the further investment into shoe will be dependent on the utilizations that we reach, or have we also planned something else within the shoe for further investments?
So we continue to look at opportunities of increasing capacity there. The shoe business, as you would be aware, is not a very capital-intensive business. It's more people-intensive. So frankly, to ramp up capacities in shoe, we actually do not require major capex. What we require is a lot of people. We require them to be trained, and then we require that entire learning curve that people need to go in. Yes, it is working capital intensive, but from a capex perspective, we don't see any major capex happening as far as the shoe industry, the shoe business is concerned.
Perfect. Just again, sorry to harp again on the shoe manufacturing, on the industry dynamics. If you can just throw more light, and since you would be closing it very closely now, it's a new baby in the whole of the game. So, how have been the BIS norms, making it more exaggerated to fasten up the local manufacturing? Plus, there has been a lot of confusion around the declared inventory, which can be sold off for more than a year. How have been you looking towards this industry as you progress ahead?
So, first of all, at the consumer level, there's definitely some amount of slowdown as far as shoes is concerned as well, like everything else as far as consumption. However, that slowdown is not affecting us manufacturers because we continue to see a huge demand for import substitution because of the BIS norms as well as because of the import duties. As far as stocks is concerned, that's something that I can't comment on because that's the brand's prerogative, and obviously the brand is not going to share that kind of information with us. All I can say is that all our factories are BIS certified. All our factories have an order book which is taking care of more than 100% of the capacities that we have. I think the pressure is on us to be able to ramp it up and to be able to deliver the quantities in the quality that the customer wants. I think that's more of a prerogative rather than fighting for demand.
Perfect. Thank you for answering all the questions.
Thank you, Priyank.
Thank you. Before we move on to the next question, a reminder to all participants, you may press star and one to ask questions. The next question is from the line of Mayur Parkeria from Wealth Managers India Private Limited. Please go ahead.
Good evening, and thank you for taking my questions. So, Samir, I had, again, the last time also I tried to ask, but is it possible for us to give any kind of color for the various categories? Because now we are a very diversified company. Even when we look at EMS kind of, whether it is mobiles, digital, electronics, there is some color which is available, at least in the presentation with respect to some contribution or growth, given the situation. Is it possible to get some color on that kind of, food, beverages, personal care, home care, wellness, household, so, into shoes. So, some color which you feel is appropriate for us to understand a little more or, two steps more into the operational understanding.
So, Mayur, I'm going to unfortunately repeat the same thing that I repeated last time. While the product categories sound extremely diverse, we have two main commercial constructs, right? Third one, which is a smaller part, but two main commercial constructs. One is we have dedicated manufacturing sites. Second is we have shared manufacturing sites. As far as dedicated manufacturing sites are concerned, whether we are manufacturing home care liquids or we are manufacturing ice creams or we are manufacturing tea, the commercial model remains the same, which is that it is a take or pay contract. So from that perspective, it actually does not make any difference what we are manufacturing as long as it's a dedicated manufacturing site. From a shared manufacturing perspective, again, the commercial model is the same irrespective of what we manufacture. So as a company, we actually do not differentiate between the different product categories. What we did realize is that the shoe business, because of the inherent growth in the sector and because of the way the entire business was shaping up, and more importantly, because it was a large acquisition for us, we did say that we will start disclosing more granular details about the shoe business, and we are happy to do that. But for the rest of it, we continue to maintain that we're doing contract manufacturing. It's either dedicated or shared. As far as dedicated is concerned, nearly 80 to 85% of our gross block is dedicated, and as a result, our bottom line, to the extent of 80 to 85% of that, is guaranteed.
No, I understand. It was just to get a little more vertical color of the user industries also, because we look at, Hindustan Foods as also a proxy of how the various verticals are panning out. One of the reasons of your diversification also has been that we want to go into higher growth categories. So how are the various categories and verticals panning out was just one of the objectives rather than the commercial and the business model. We understand that, so it's okay. Fair enough. At some point of time, we will look.
Mayur, that's exactly the reason why we do not want to give the granular details.
Yeah, I understand.
Because unfortunately, then people will start asking us how much ice cream has Unilever sold and how much ice cream has Nick sold.
No. So not at the customer level, but surely it's okay. I understand. Okay. So second question, just to look little deeper into the numbers, and please help me understand if my understanding is also right here. I'm looking at H1 of FY24 versus H1 of FY25, right? 107 crores of EBITDA versus 148 crores of EBITDA on a revenue of 1,300 versus 1,757, round of figures. The margins as reported 8.2 and 8.4%, right? So what I was trying to understand, the fact that the profitability is almost flattish or low is because of the depreciation rise and the interest rise, which has been large impact. So to understand this properly, we are saying, while I understand the team mentioned that 6 crores additional cost could have helped the margins to be slightly higher. But when we look at this number of around 8.2, 8.4%, it tells us that the operating structure of even the shoe or the ice cream and the beverage is not already different from what we had in the existing situation. It is the capacity. Is it because the depreciation and interest is underutilized? Is it an issue of capacity utilization? That is one thing. And secondly, if you are saying that this can be increased further, then are we saying that the 8.4 can meaningfully go up, which means that the incremental business is at a much better margin profile? Because you mentioned that these businesses are also at similar margin profile. So I just wanted to clarify if my understanding was right into the numbers.
Yeah, Mayur, we've traditionally and always emphasized that looking at margins in our business would kind of lead to distorted analysis. You have to appreciate that between last year and this year, commodity prices have started rising again. So some of our revenues have risen just on the back of the fact that commodity prices have gone up. I mean, Ganesh can make a list of items where prices have risen by as much as 20-25% in the last 1 year.
The gross margins are stable, or rather increased only. So I think
the gross margins would have to be stable because it's a pass-through for us, right?
Yeah, so in fact, that's taken care of, right? Yeah.
Any kind of inflation actually it gets passed on immediately to our customer. And as a result, our EBITDA numbers, as far as the dedicated manufacturing sites are concerned, actually remain the same. So your margins at EBITDA level and below would probably start falling if our revenues grow disproportionately. For the very simple reason that the EBITDA from a particular factory would remain constant, but the throughput would increase substantially. Now, coming to the shoe business, it's a fair question, but it's slightly premature. That I don't think we are in a position to actually give out any kind of details in terms of margin profiles, etc. We've been into the business barely in the last 6 months. I think we do not have a trend. We do not know whether the current environment is a normal environment. Is it an environment which is beset by inflation? How are things going to change in the next couple of quarters? We will definitely start sharing some more granular data as far as shoes is concerned, both in terms of top line margins, etc. For the time being, our expectation is that it will have a similar margin profile. Whether that expectation is right or wrong, I really don't have any kind of data to be able to say it right now.
And coming to your last part, EBITDA margin, are you referring to similar EBITDA margins, or are you referring to RO? Means which margin level are you just to understand?
So I'm saying that I cannot understand any of the margins. So neither EBITDA, nor PBT, nor PAT. So I'm not understanding any of the margins.
Our reported numbers are already at similar level. So means just
our reported numbers are also at a similar level because the 6 to 7 crores loss is coming in at a figure. The depreciation and interest is fully captured, right? Since the facilities have already ramped up, and the auditors won't allow us to capitalize any of that. So the figure of finance and depreciation is already captured. So जो 6 से 7 crore का नुकसान है, that would have come in directly at the top line. It would have flown directly to EBITDA, and it would have flown directly to the PAT number, and maybe not PAT, but at least PBT number. So, like I said, the shoe business. Sorry, did I confuse you enough on that one, or should I continue?
No, so actually I was linking since the margins are almost similar even for the quarter on a year-on-year basis, as well as on the half year. The narrative that the business is not yet efficiently run, and on the fact that these businesses are expected to have similar margins, I think it's already there in the number. So where is this disconnect, or why you feel what we're trying to understand? Does that mean that it can go up from here, or does it mean that the capacity utilizations are a problem, which is just that the PAT and EBITDA difference is not there? So
Mayur, I didn't want to do this, but I'm going to really break it down. The 6 to 7 crore number that Mayank spoke about, and that's a big if, right? If we had not lost that money, our EBITDA would have been higher, and I'm just looking at the numbers here. Q2 number or H1 numbers was 148. It would have been 154, right? I mean, it's just a plain addition of 148 plus 6. Similarly, our PBT, which is 68, would have been 68 plus 6, help me here, 75, right? And our PAT number 50, assuming a 25% tax, we would have been around 54 crores. So from that perspective, all the margins would have changed anyways. The revenue would have remained the same. So margin profile would have become better. To answer your question, at the expense of, again, caveating it that I do not have enough data, the gross margin in the shoe business is higher. The EBITDA margin in case of the shoe business will also be higher for the very simple reason that the shoe business is an extremely high asset turn business. It has a lot more people rather than a lot more machines. And hopefully, if we manage to turn this around, you should start seeing that both in all the three, in EBITDA, in PBT, as well as PAT.
Great. Last final question from my side, just the gross block of 1,800 crores expected by FY26. Currently, like to like, we are at 1,250 odd crores, right? So we are talking of a 550 crores of incremental capex. So two questions here. One is, how do we expect this 550 crore to be funded? Because I'm sure on the EBITDA side, on the cash flow side, on just remaining 18 months, we will not have this kind of. So how do we expect this? So what can be the debt equity at the end of FY26? That is one. And out of the 1,800 crore, broadly, given the plan which we have, how much would still be CWIP, capital work in progress, and how much would have got capitalized, so that we understand that what can be the asset turn. Am I clear with the question, sir?
Yeah. So, hi, Mayur.
Hello.
So, we have told that it will be around 1,800 on the back of two new ice cream plants, which is around 400 crores, and some investment in the current factories which we are doing, right? So currently we are at 1,250, 1,300, and for this around 500 will be more. So that is how we are going towards the 1,800 crores figure. Now to answer your question, to fund it, we have raised some money in January this year, which is in the warrants form. Some money of that is still to come, around 225 crores is still to come. And because these projects are also dedicated models where there is a debt equity always there. If we even take 1:1 debt equity ratio, then also this 500 can be completed in the next 2 years.
Okay, so broadly 250 odd crores versus 250 odd of our own can be. This is how one can look at broadly.
Right. Yes.
And
so at the end of FY26, we expect the gross block to be around 1,800 crores to 1,800 to 2,000 crores. We expect the debt to be about 1,000 crores and the equity to be about 1,000 crores.
Great. And the second part of the question, how much of this 1,800, because it's a phased expansion, so out of this 400 of ice cream, how much would have got capital on the other, which is another 100 crores, how much would have got capitalized incrementally, or how much would be CWIP?
So major part of it will be capitalized because one Nashik ice cream plant will be fully functional by 26. The new plant which we are talking about will be in the phased manner where 75% of the investment would have been made till 26 and 25% will be remaining.
Great. Thank you so much and wish you all the best. If there is a possibility, I'll come back in the queue again next. Thank you.
Thank you, sir. We have our next question from the line of Devesh Advani from Reliance General Insurance. Please go ahead.
Yeah, thank you so much for the opportunity. Actually, what I wanted to understand is that...
Devesh, can you speak a little louder, please?
Hello, is it audible now?
Much better.
Yeah. So, what I wanted to understand is that revenue has grown close to 35% in the first half. So what is the guidance for the second half, and how do you see the bottom line in the second half going forward?
Devesh, we all are dumbfounded. We are not sure what we are supposed to answer to this. The politically correct answer is that we do not give a guidance.
Okay.
Right? And the practical answer is that given that nearly 80 to 85% of our business comes from a dedicated manufacturing setup, We have clear visibility of that. So 80-85% of our turnover should get repeated quarter after quarter, year after year for the next 7 or 10 years. The part about the ramp up of shoes is something I think we've already spent a substantial part of the call on. If you add the two, you should reasonably get to what our final numbers for the year should look like. In terms of the bottom line, again, 80-85% of our bottom line comes from dedicated manufacturing. If you see this quarter's number and if you compare it to our last quarter's number, you'll see that it's pretty much flat. The only delta, as I was trying to explain to Mayur in the earlier question, was the shoe business, which has depressed it by about 6 to 7 crores. So you can extrapolate that and then do a sensitivity analysis on how much do you think or when do you think we can turn around the shoe business.
All right. Thank you.
Thank you. We have our next question from the line of Akhil Parekh from B&K Securities. Please go ahead.
Hi. Thanks for the opportunity and many congratulations to the team for continuing with the 30% plus growth rate for the last quarters. Samir, my first question is on the legacy FMCG business, right? I mean, what is the general client feedback that you are getting? I mean, we've been hearing obviously the slowdown has been severe in urban markets, but any possible signs of improvement given that the monsoon was good? Can we see some improvement in that part of the business in subsequent quarters? Any feedback from our clients?
So Akhil, like I said, we generally prefer not to act as proxies for our customers. From HFL's perspective, whether they are legacy brands or new brands, we continue to grow. Some of the expansion that is happening, which has been announced by Mayank and Ganesh earlier in the call, is being done by the traditional brands or the older brands. Some of it is being done for newer brands. Our client mix is changing. So while the broader FMCG market does continue to face pressures, that's something I think everyone knows and is talking about. We are still trying to find at least some sectors or some clients who are growing and trying to pitch for their businesses. So from that perspective, I think this quarter has been interesting. We've been able to sign up a few new customers. We've been able to do some M&A as well. And we do have now a clear visibility. When we spoke about this the previous quarter, we weren't very sure about how we were going to reach to our goal of 1,800 crores on the gross block by FY26. We now have more or less clear visibility, signed agreements for that figure. And I think from that perspective, I think this will hopefully we should be able to keep repeating this, whether it is with traditional brands or new brands. That's immaterial.
Okay. So second, the price inflation, you already mentioned that the commodity prices continue to be at elevated level. Has that trend remained same in 2Q and because our gross margins have expanded, right? So in last 3 quarters, part to do with the inflation and part to do probably with some product mix. Any guidance for like say rest half of the year? Should we kind of build in similar kind of a gross margins given that we believe that inflation has remained sticky as well?
Okay, Akhil. So if the inflationary environment persists, and I'm no expert on whether it will persist or not, I'm not sure. So help me here. I'm not sure why the gross margin should improve if it will actually decrease. That's what that's exactly my question. So if the inflation continues, our gross margin will, I think, decrease, Akhil. So the change in the gross margin that I think Mayur or someone else was referring to.
My bad. Yeah. So that's what I implied. Like whether it's like this level of gross margin should we anticipate to continue for at least next 2 quarters based on your understanding about the price inflation at this point.
So the gross margin for us has nothing to do with the inflation. The gross margin has to do with the product mix. So as far as the product mix is concerned, broadly, most of the FMCG products fall within a similar gross margin bracket. The shoe business does have a different profile, but like I said earlier, it's a little early for us to be able to comment on how that's going to pan out in the next 6 months. Give us some time, and we'll be able to give you some more granular data about the shoe business and how that affects the overall top line and the gross margin of the business. As far as the inflation is concerned, the only thing that it will do is it will probably improve our revenues more than that you can give credit to us for.
But as of now, we are not seeing any signs of price deflation that is.
No, price deflation? No, actually we are seeing inflation. No, I think just today in economic times they talked about around 6% inflation in the food prices and some other stuff as well.
And last one, apex of I think HPC segment, right? In Hyderabad we had mentioned last quarter, but we didn't see anything in press release. So any timeline around which we will be able to complete that, the brownfield expansion?
Sorry, Akhil, I missed that question.
I'm saying the last quarter we had announced, I think around 50 crore of brownfield expansion in Hyderabad, if I'm not mistaken. What is the timeline for that?
Oh, so we did the groundbreaking just about 2-3 weeks ago. We started construction there. We are hoping that we get commercialized by May or June latest of CY25.
Okay. Yeah, that's all from my side. Best wishes.
Thank you. We have our next question from the line of Priyank Chheda from Vallum Capital. Please go ahead.
Yeah, thanks for the opportunity, sir. Lucknow plant is again an anchor tenant or a dedicated manufacturing site? And as well as the North new greenfield in the ice cream that you're planning, what would be that also? Would be anchor or dedicated?
Priyank, I'm sorry. Can you just repeat that question?
Lucknow is anchor tenant or...
Okay. Mayank heard your question, so maybe he can answer it. Go ahead.
So, Priyank, Lucknow is a pure play dedicated site towards the multinational. And as of now, because for the new plant, it is too early to say because we are just starting to look out for the land, and if possible, we will try to have another customer in there to make it anchor tenant. It will be better for us also.
Perfect. So in ice cream, Nashik is anchor tenant and North would be also anchor tenant. Which are the two new models, possibly if North get anchor tenant. So there will be two facilities of ice cream which would be anchor tenant model versus, is that understanding correct?
Okay, so let me just repeat all of that, right? So the Lucknow facility is a dedicated site for one customer. The Nashik site has a large portion of the capacity dedicated to one customer and a part of the capacity dedicated to another. So while it's from a perspective of the fact that the entire capacity for Nashik is spoken for, it is dedicated from that perspective, but it's dedicated to two customers as opposed to, let's say, Lucknow or Hyderabad or Coimbatore, where there's only one customer. As far as the new greenfield site which is coming up in North, like Mayank said, it's a little premature. The current contract or the current announcement is on the back of an agreement, like not a formal agreement, but an understanding with one particular customer.
Got it. So what the whole purpose of asking this was to try to understand the incremental gross block that we'll have. Given the current gross block where we have 85% dedicated, the incremental gross block that we plan to do, which is around 550 crores, would the ratio of 85% to 15% remain as it is, or is there something changing? I understand the shoe part, which is completely in our hand. What would be the incremental part, and the last part is ice cream?
So we will continue to strive for maintaining that 80 to 85% part of the gross block to be dedicated. The only difference that is happening, which I referred to in my opening remarks as well, is that we are signing up new customers. We are getting into new categories. So from that perspective, it's riskier, but it's definitely still dedicated.
Got it. And on the balance sheet side, now that our debt levels are at 750, while we also have uncalled money from the preference of almost around, I guess, more than 250 crores. So how would we think about it? What would be the gross debt number that we should think for FY25 and 26?
I think Mayank just mentioned that earlier.
Yeah. So for this, the new capex which we are envisaging for 550 crores, it will be mix of debt and equity of 1:1, because as you rightly indicated that we have the warrants money to come in around 250 crores, and if we take the 1:1 leverage also, it will help us in getting the capex which we are envisaging right now.
Perfect. Thank you.
Yeah.
Thank you. As there are no further questions, I would now like to hand the conference over to Mr. Mayank Samdani for closing comments. Over to you, sir.
Thank you, Manav. We are currently navigating integration challenges. However, with the promising outlook in the footwear industry, we are confident in our ability to deliver strong results. Our recent acquisition in the beverage segment further reinforced our confidence in expanding our footprint within this market. Overall, at HFL, we maintain a positive outlook on our performance trajectory, backed by these strategic advancements and our commitment to growth. I take this opportunity to thank everyone for joining on the call. I hope we have been able to address all your queries. For any further information, kindly get in touch with us or the strategic growth advisors or investor relation advisors. Thank you very much and a good day.
Thank you. On behalf of Hindustan Foods Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.